Are you ready to become a better investor? This is Andrew Stotz of A Stotz Investment Research, and I'm excited to show you my new China Equity FVMR Snapshot, or what I like to call China in your hand every week. When you sign up for this, you will always be up to date because every week you'll receive this China Equity FVMR Snapshot. You're going to know all your numbers, because this one page covers fundamentals, valuation, momentum, and risk, what we like to call FVMR. You're going to be professional. You're going to use the same information as institutional investors and fund managers around the world. And the best part is you do nothing. Once you've signed up, you're going to receive a one-page PDF every Monday of this information. Print it out, put it on your desk, use it when you're writing stuff and trying to analyze what's going on in the world and what's going on in China. So let's look at China in this case. Most of the time when people are talking about China, we're talking about China H shares, meaning the shares that are trading in Hong Kong. But this FVMR snapshot is a proprietary bottom-up aggregation of 1,849 Chinese companies that are listed as either A, B, and or H shares. So basically, there's about 3,000 companies in China, and these are the most largest and liquid companies. And what we can see is that the biggest sector with the most number of companies is industrials. The smallest is telcos, which we know that telecom companies have a bit of a monopoly in most countries around the world. They're given that monopoly through the government. So let's take a look at what we can see. Let's start with fundamentals. In fundamentals, I look at the profitability through return on equity and then look at the dividend payout ratio to understand what you as an investor get. So let's look at a few different highlights. The first thing we can see is that the expected consensus return on equity for the world is about 13% in 2016, and China is a little bit less at 12.5%. The next thing we can see is, let's take consumer staples sector, where we can see a steady 16.1% return on equity, which is actually expected to increase from 15.7 in 2015. If we look at dividend payout ratio, we can see that the telco companies tend to have very high dividend payout ratios, and that's good news. We get a lot of dividends and income out of them. If we look at the next area, which is valuation, we can see price to earnings and price to book in this case. Now, we can look at the materials sector and we'll see 56.8 times PE. This is because the materials sector is producing very tiny net profit at this point because of the collapse in oil price and other commodity prices. So what we can also see is financials are trading at about 7 times PE. And this is pretty normal for financials around the world to trade at low PE multiples. But China financials are going through their own struggles right now as the overall market has declined and the economic growth is falling. Now, price to book, we can see for the financials is slightly below 1. Again, not a very cheap measure when you think about financials globally, particularly when you think about what China is facing in their slowdown in their economy. And we can see information technology companies. This is the Alibabas and the other companies that we've seen come to life globally for China. We can see that the price to book is about almost 5 times, and PEs are 30 to 40 times. Not unusual for tech companies these days. Let's move on to momentum. I look at earnings momentum and price momentum. And now let's see some of the things that we see. Of course, we can see a collapse in the earnings of energy companies thanks to the fall in oil prices. We can also see that the EPS of the infotech and the technology stocks are very, very high as they continue to grow very strongly. We can see that 26.5 was what they produced in 2015, and analysts are expecting 36 in 2016. Now let's look at price as far as momentum is concerned and take a look at telcos as an example. The 2-week price momentum has been about 3.2%. Now let's look at a 1-year price momentum. What we can see is the world's price, the price of the world market is down by 12.6. The price of China is down 5.6. We can also see that energy sector is down 28.2. But it's interesting to see that China's only down 5.6. But remember that we're looking at almost 2,000 companies that are listed across China, not just the top largest market cap, which are listed in Hong Kong. And hence we can see that there's not as big of a collapse in share price across the broader market. And what we can also see is the fall in share price in the financials as people are concerned about the conditions of the economy there. The next thing is risk, where I look at gearing or net debt to equity and price risk. If we look at this, we can see that consumer staples, much like they are around Asia, are in very good position as far as gearing. In fact, they have net cash. If we look at the price, we can see that the price volatility of China is about 33.8 compared to the world index at 16.4. Now, we want to be careful comparing the world against a individual country because the aggregation of all countries causes the price volatility to fall. But if we were to compare that price volatility to, let's say, the US would be close to 20%. China's at 33.8. So we can also see that some sectors, for instance, we can see the financial sectors has a 1-year level of price volatility of about 35%. So when you sign up for this product, what will you get? You're going to always be up to date. You're going to know all the numbers. You're going to be professional. And the best part is you don't have to do anything after you sign up below. Click on the link that's in this video or go to the website at babinow.com. If you aren't already there, have a great day.